purchase gold, the government does not give me any sovereign guarantee apart from sovereign gold bond.
Yes. Can run in all
technically
types
there is
of,
no sovereign guarantee.
can run in all types of market cycles.
Okay, are you sure about this? I am sure you would have heard this statement that whenever the equity markets are performing, the gold does not in general perform.
Yes, sir.
Right. So how can you say that it performs in all kinds of markets?
Yes, sir.
So capital guarantee?
Capital guarantee. Are you sure about the capital guarantee? Because what if I purchase gold today and maybe I sell it 3 months later and the prices are going down? There is no capital guarantee.
Worldwide accepted and consistency.
Okay.
Internationally accepted asset class, just like say US dollar, gold, etc.
Okay. Very good. Well tried. That's it.
Hello?
Yeah, come again, please.
Sir, your principal is actually safe. That is safe.
Are you sure your principal is safe? If, for example, the prices do not move for a very long time, I purchased it 5 years ago and currently it is in loss. Who is going to guarantee my principal if I want the money right now? Are you getting my point?
Yes,
No,
sir.
sir. Can you please elaborate it?
I am coming to the answer.
Sir, safe.
I have not agreed to, Rajini ma'am, I have not agreed to any of these answers.
Hello.
Yes, please.
Assets which value does not depreciate with the time.
Okay.
Whereas principal value is almost safe. Almost, so you can say it is fully safe.
Fully safe.
If it is whether it is making return or not, but the principal is fully safe.
Okay, wonderful. Perfect.
Not
Like
volatile
RBI
with time.
bonds, you can say in case of India, or FDs, you can say it is also very much safe with the rate.
Okay. SM40 DEL wealth.
Sir, can real estate be included?
No, real estate is not safe haven asset.
Not volatile.
Not volatile. That I've already got an answer. Okay, I would not say that you are wrong. Someone has raised the hand. I am not sure who are they. Can you please unmute yourself directly and tell me the answer if you have something to say?
Sir, I think we cannot say that there is any safe asset. I think it is a comparatively steady. Like gold is a safe asset, but it is actually not a safe asset because its value can change.
That is why. No. First, we need to understand what is the definition of safe asset. That is what I am saying, that I have not agreed to any of these definitions. It is just that I am accepting these answers for now. I would be sharing my thoughts in a while. I just want to hear your thoughts here, that according to you, what do you mean by a safe haven asset? So now I am going to discuss with you. Broadly, there are two different type of assets. Can everyone please mute themselves again? Thank you so much for your answers. So broadly, let us try to understand here, guys, and this is a very, very important topic for us to understand. And let me tell you one thing, that this topic that I'm going to discuss now about the safe and the risk assets, and the topic that we are going to discuss here on, is going to help you out throughout your entire life, whether you are managing someone's wealth or you are managing only your own wealth. Whatever you are doing, if you are investor and if you are a part of the financial market, that this concept is going to definitely impact you in longer run. And whatever I'll be discussing with you should not be seen for the shorter time frame, unless until mentioned, I will be talking about the broader time frame. Broadly speaking, there are two different type of assets. One is a safe asset and other is a risk asset or a risky asset. The technical word is risk asset. What do you mean by a safe asset? And then we will be talking about that what are the different examples, what are the different type of safe assets, and whenever the central bank makes such certain kind of policies, तो इसका in safe और risk assets पे क्या क्या impact पड़ता है, how does it impact safe and risky assets, is what we are going to discuss here on. So broadly there are two types of assets, safe asset and risk assets. What is a safe asset? A safe asset, the technical definition is not the one that you all mentioned. A safe asset is any asset, listen to me carefully, any asset that has a negative, low or no correlation with the economic cycle is called technically a safe haven asset. In terms of fund management, in terms of portfolio management, in terms of the global economy, in terms of the asset classes, any asset that has a negative, low or no correlation with the economic cycle is called a safe haven asset. Now, which asset has a negative correlation with the economic cycle? We all know the statement that we just made here, that we have heard for a very, very long time, ever since we started studying finance. I am sure you must have heard this, that whenever the equity market goes up, the gold prices do not perform, and whenever the equity markets do not perform, the gold prices go up, the gold prices perform. In the times of war, the gold prices perform, the equity markets crash. In the times of financial crisis, the gold prices go up while the financial markets crash. And in the times of some other turbulences, also when the equity markets are not performing due to certain other reasons, the gold prices perform while the equity markets do not perform. Again, there can be certain exceptions. Yes, I do agree that there can be certain exceptions, but broader definition in finance is that anything that has a negative, low or no correlation with the economic cycle, they are called the safe assets. Like for example, one is gold. Rather, the broadest, the most important safe assets or the most widely accepted safe haven assets are these two assets, which are dollar and gold. And what is risk asset? What is risky asset? A risky asset or a risk asset is the one that has a positive correlation with the economic cycle. For example, equity. For example, metals. For example, crude oil. For example, real estate. Real estate prices go up when the economy is booming. When the economy is not going up, when the economy is not performing, then the real estate prices do not tend to perform. Barring certain areas, I mean, unke real estate prices maybe temporarily बढ़ सकते हैं, but broadly, the real estate perform when the economy performs. So there are two types of assets, safe assets and risk assets. Safe assets are those which have a low, no or negative correlation. For example, agriculture commodity. Let us say today the economy is expanding and I generally have, or let us say today the economy is contracting and I generally have, let's say 2 chapatis in dinner. When the economy will start expanding, will I start having 3, 4 or 5 chapatis? No. I might develop different food habits. For example, I might have some high protein rich diet. I may leave carb and start eating protein. That's a different thing. But then broadly our consumption remains the same. The consumption pattern may change, but the broader consumption remains same. So agriculture commodities, dollar, gold, these are broadly safe haven asset. Apart from this, we have Japanese yen. Apart from this, we have Swiss franc. These are the safe haven assets, out of which the biggest and the most widely traded and invested safe haven assets are gold and dollar. The risk assets are broadly equity. So we are now dealing with 3 kind of assets. One is equity, second is commodity, third is currency. One is equity or stocks or index, second is gold, and third is dollar. Now, whenever there will be an increase in money supply into the system, so whenever there will be an expansionary monetary policy in the country, okay, before that, whenever the money flows into the safe assets, there are 2 safe assets, one is gold, other is dollar. So पैसा या तो फ्लो करके डॉलर में जाएगा, पैसा या तो फ्लो करके गोल्ड में जाएगा, which means gold and dollar also have opposite relation with each other. Gold and dollar also have opposite relation with each other, which means when dollar goes up, gold comes down. When dollar goes down, gold goes up. Which means whenever there will be an increase in money supply into the system, we have already studied that dollar is not going to perform, the dollar will be depreciating. So whenever the central bank will be decreasing the rates, whenever central bank will reduce the rates, this will increase the money supply into the system. Whenever the money supply in the system will increase, the price of the dollar will go down. And let me tell you here like this also. Let me try to explain you like this. Can someone tell me, or let me just tell you, what is the price of gold today? The price of gold today is approximately, let's say, $1,900. Whenever dollar goes up, so because you have to purchase gold, whenever dollar goes up, you will be able to purchase less amount of. Shamdarji, can you please mute yourself? So whenever the dollar prices go up, you will be able to buy less amount of dollars. With this less amount of dollar, you will be able to buy less amount of gold. With this less amount of gold being purchased, the price of the gold will go down, which means when dollar appreciate, gold prices come down. Similarly, when dollar depreciate, gold prices go up. So the first lesson that we get to learn here, from headlines to portfolios, whatever they are talking about, whatever they are thinking, whatever policy making they are doing, any policy making that will increase the money supply into the system, it is likely to reduce the price of, anything that will increase the money supply into the system will bring the price of the dollar down. And whenever the price of the dollar will come down, the price of the gold will go up, which means whenever the central bank is going to take action on the monetary policy, whenever the central bank will reduce the money supply, or whenever the central bank will do the open market operation which increases the money supply into the system, whether it is quantitative easing, whether it is printing new money, whether it is open market operation, whether it is decreasing the interest rates, any kind of rates, this all will increase the money supply. This all will decrease or depreciate the value of dollar, and hence is likely to support the gold. So any expansionary monetary policy is likely to be very positive for gold prices. This topic is not over yet. I would like to state a couple of more statements here, and then I will open the floor for questions if you have any question on this. And then, sooner or later, we will be discussing various data points that is going to impact all our asset classes. First, we are starting with gold here. If I ask you, no need to unmute yourself, no need to answer. I will give you 10 seconds to think about it, and you have to reply me in the chat box. What does bond market gives you? What does bond market gives you? A bond market gives you a bond market gives you capital appreciation. You purchase the bond at, for example, 95 rupees and you are able to sell it at 100 rupees, or you will be able to mature it at 100 rupees. At the same time, it gives you some fixed interest. So the bonds give you capital appreciation and interest, fixed interest. What does stock give you? What does a stock give you? A stock give you capital appreciation and variable dividends. What does gold gives you? Gold gives you only capital appreciation, which means whenever there is less money supply into the system, people would start moving towards debt market because the money supply is less and they are chasing the safe returns. Whenever the money supply increases, the money starts moving from debt market to the equity market also, which means the equity market will also start going up. Whenever there will be more further increase in money supply, the money starts flowing from equity market to commodity market to gold market itself. Which means whenever the money supply in the system increases, the price of the gold immediately shoots up. Which means whenever the money supply in the system decreases, the first asset class जिसमें से पैसा निकलेगा, that will be gold. Which means whenever the central bank makes a contractionary monetary policy, it is going to impact gold heavily. The gold prices would tumble. The gold prices would panic. They would fall sharply. And whenever, and by the way, let me tell you one thing, the stock market or the commodity market, this entire financial market, it does not discount the events of today, it discounts the events of tomorrow. It already factors in the events for tomorrow that's going to happen tomorrow or maybe later. Which means whenever the central bank even think of increasing the rates, the gold prices would come down, and whenever the central bank would start giving you indication that the interest rates are likely to come down, we are likely to decrease the interest rates, the gold prices will be the first thing to shoot up the market, to shoot up higher. I am pausing here for 30 seconds. Does anyone have any question for me? So any expansionary monetary policy will increase the price of gold heavily and also equity to some extent. And any contractionary monetary policy will put pressure on gold prices and also on equity markets. Now, when we talk about the central bank, we are not just talking about the India Central Bank, the Indian Central Bank or the Monetary Policy Committee, which makes the monetary policy every bi-monthly, every 2 months. So they increase the repo rate, they decrease the repo rate, reverse the repo rate, CRR, SLR, whatsoever. But as I made the statement earlier, I said that a central bank, India Central Bank, is unlikely to reduce the rates if US Central Bank is increasing it. So broadly, there are 5 central banks that impact the global financial markets. I will be talking about these concepts for only next 10 to 15 minutes or so, and after that I'll open the floor for all kind of questions that you can have for me. So please listen to me very carefully. This is one of the most important topics that we are going to discuss. At least for handling my own portfolio, I have found it to be very, very useful. So broadly, there are 2 kind of policies, expansionary, contractionary. There are 2 type of assets, risk assets and safe assets. In safe assets, there are 2 kind of assets, dollar and gold. They both have negative correlation amongst each other. And also then there is another asset which is equity, which is a risky asset. So safe and risky assets, they have a negative correlation. Among safe also, there are 2 kind of assets, dollar and gold. Again, they have a negative correlation. Think of this entire scenario as someone juggling 3 balls, which means at any point in time, 2 balls can be at the max on the higher side, while 1 bond will be lower.
We'll bring everything because for investment.
So there will always be, at all points in time, there will at the max be 2 asset classes which will be performing, and one asset class will either be going down or not performing temporarily. So now there are 5 central banks which impact the movement of the dollar, which means, let me tell you one thing, that dollar is something which is driving the market. Because when dollar goes up, gold comes down. When dollar goes up, equity also might come down. So which means the mother of all asset classes is dollar. Now the important question is, what drives the dollar? If you understand what drives the dollar, then we have understood the entire financial market and how the money will be flowing from one asset class to different asset class. What impacts the dollar? The dollar is primarily impacted by the central bank policies, and there are 5 central banks which are important for us apart from India. One is US, UK, Eurozone, Japan and China. These are the 5 central banks that impact our financial market. Rather, US being the largest financial market, they are the drivers of the entire monetary policy. They are the driver of the entire monetary policy. As I said, if US increases the rate, India is likely to increase the rate or keep it constant. If US decreases the rates, then only India will be able to decrease the rates. Otherwise, the money would start flowing outside my country. If, for example, US interest rates go high compared to India and the gap is narrowed, in that case, the FIIs would not prefer to come in India, rather they would like to go out of the country. So any money supply, anything that increases the money supply decreases the dollar. Anything that decreases the money supply increases the dollar. Dollar impacts all other asset classes, and the money supply is managed by the central bank, and the central bank, the most important one being the US central bank. The US central bank, important thing, the US central bank makes monetary policy every 45 days, every 1.5 months. Which means that every 45 days, my financial markets are going to get impacted. And I would like to show you that how. I hope you are able to see the screen of mine where I have opened investing.com and I can see some chart. In this chart, let me make it India's chart, and this is a very, very important thing that we are going to notice here. From portfolio management point of view, from wealth management point of view, that how these assets are correlated with each other. Let us say I open the chart of gold, the symbol being XAU USD. This is let us say this yellow colored is gold, and now let me add dollar on this. Basically dollar means dollar index. Dollar index is the value of dollar against basket of 6 major currencies, not just India. So whenever you see I have applied the value of dollar here, and let me darken this line a bit for you. I hope you are able to see. You see the red one is the value of dollar and the yellow one is the value of gold. I hope you are able to see this relation. Can you notice here? Whenever the value of the dollar appreciates, the price of the gold depreciates. The dollar starts depreciating, the gold starts appreciating. The dollar starts appreciating, the gold again starts depreciating. Pick up any area, pick up any time frame of your choice. I hope the experience is same everywhere. So which means that dollar, I hope this justifies the statement that dollar is the driver of the financial markets. So if dollar goes up, gold comes down, as we can see here. The bigger question is, what is driving the dollar? That is what I am answering in the next 5 to 7 minutes. What drives the dollar? The dollar is driven by the central bank policies. Again, this we have already covered. The bigger question is, even the bigger question here is that what drives the central bank policies? Basis what the central bank is deciding whether we need to increase the rates or decrease the rates. This is one last thing that we are going to discuss today, and this is one of the most important things. If dollar will go up, the USD INR will go up. The USD INR goes up, the Nifty prices are not going to perform. Because it means that the money is shifting in the dollar and out of Indian rupee. When USD INR goes up, Indian rupee depreciates. Indian rupee depreciates means FIs are pulling out their money. These days you are noticing that dollar USD INR is appreciating and Nifty is also appreciating. But let me tell you one thing. What happens tomorrow, I do not know. But my best sense says that this system or this thing is going to be very, very temporary. Only in the next couple of days you will be able to notice that one of these things would start depreciating. Either USD INR might come down or Nifty might come down. I do not know what is going to come down, but then they both cannot go in same direction for a very long time. It is only a temporary phenomenon. The central bank, which makes two types of policies, expansionary and contractionary, they decide what kind of monetary policy they have to make based on the situation in the country. And when we talk about the situation in the country, basically we are talking about some of the key factors which impact the financial markets, which impact the central bank thought processes. I am going to take you to this news economic calendar. This week tomorrow itself, we have a very, very important data point. Now guys, understand one thing. Very, very important thing. How important is US? How important is US? US holds such an importance in our lives is that think of US as a businessman from a village, for example, as a Lalaji from a village itself, wherein all the people in the village are directly or indirectly dependent on this Lalaji. Like for example, he runs around 2-3 factories and also hire a lot of youth from the village. Now, if this Lalaji is happy, then the entire village is happy. And if the Lalaji is not happy, then entire village, I mean, they would not be able to earn enough amount of money because the Lalaji is not earning. How will you get to know that Lalaji has got a lot of money? If his business is running. Now, for example, let's talk about US. US imports cars from Germany, technology from Japan, manufactured goods from China, IT services from India, banking services from UK, toys and textile from Bangladesh, Vietnam and India, and so on and so forth. So US is a very, very big consumer. If US grows, entire world grows. If US catches cold, the entire world catches fever. So it is important for us that US grows so that the entire world grows. Why? The statement seems counterintuitive also and not very pleasing to ears. But then, because US is approximately 25%, more than 25% of the global GDP. Out of around $80 trillion, around $25 trillion is generated in US, which is approximately 30%. So 30% of the global GDP is US alone. And these are just 30 crore people, around 1/3 or 1/4 of India. So when they spend a lot. They spend by borrowing also. They are such large consumers. They are such large spenders. How will we get to know that they spend a lot? If their employment is high, if they are earning good amount of money, then they are likely to spend heavy amount of money. So there is one data, I will take you to this data here, which will be released tomorrow. Like for example, if we go to tomorrow, you will see there is a data, a very important data tomorrow, which is US non-farm payrolls. This data is released every first Friday of the month. This data is released every first Friday of the month, evening 6 p.m. Now, if this data comes out to be significantly good, it means the US is earning heavily. The US is earning good. And when US earns good, it spends good. When it spends good, the GDP increases, the global GDP also increases. And currently, for example, when US non-farm payrolls is growing, the US Federal Reserve will have more guts, will have more stamina to increase the interest rates. So otherwise, in a general scenario, whenever the US non-farm payrolls increases, this is an indication of the global GDP or the US GDP increasing. When this happens, then the US equity market goes up, and hence the India, Germany, France, all these equity markets go up. I mean, whether one goes up by 20%, other goes up by 6%, that's not the question. But whenever the US non-farm payrolls comes out to be very, very positive,